Welcome back to Global Equity Research, powered by Softgate Capital Research. I'm Emily Carter, here as always with my co-host David Mitchell. We have an intriguing episode lined up. Today's focus is HCA Healthcare, a company that's, well, kind of the 800-pound gorilla in the U.S. hospital space. David, before we get into the details, a quick reminder. Softgate is our home base, and like always, we scour the sector for stories that blend scale, strategy, and, actual numbers that matter to investors.
That's right, Emily. Thanks for the handoff. For anyone new, HCA Healthcare is, simply put, the largest for-profit hospital operator in America. 190 hospitals, over 150 outpatient centers, millions of patient encounters each year. And they're not just spread out randomly. HCA clusters these assets in high-growth markets, think Florida, Texas, Georgia, Tennessee, using what they call a hub-and-spoke strategy. It lets them dominate local referral patterns, squeeze efficiencies from centralized buying. You'll hear about their health trust arm, and give physicians reasons to stay in the system.
Right, and that market density thing, you see it in other industries, but healthcare is unique. Clustering hospitals and outpatient centers means patients flow through a network, and HCA can deliver a continuum of care. They also lock in referral paths, toughen their negotiating muscles with insurers and suppliers, and reduce overhead. I imagine for a hospital executive, it's a little like, building moats around your castle, but the castle keeps growing.
Exactly. And HCA isn't just about owning a ton of hospitals. They're disciplined with capital. They've got a steady quarterly dividend, recently hiked to 72 cents a share, and they're aggressive about buybacks, over $6 billion worth in 2024. They're also sharp on leverage. Unlike some peers, they know how to manage debt, keeping it right around that 2.7x EBITDA range so they still have financial flexibility.
Before we dive into the financials, David, let's ask this. How does clustering so tightly in growth markets, this hub-and-spoke model, create a durable competitive advantage? Is it just about scale, or does it go deeper?
That's a great question, Emily. It's about scale, sure, but also local dominance. When you have a big presence in one area, you influence referral paths, become essential for insurers, who can't really ignore you, and attract physicians by offering every specialty under one roof. Patients get convenience, and HCA makes sure they're the provider of choice when healthcare dollars get spent.
So, David, from the analyst seat, why do investors pay a premium for HCA over other hospital stocks? I mean, we see the numbers, but why does the market keep rewarding this model?
Good one. It comes down to HCA's mix of growth, resilience, and margin discipline. Investors love the non-discretionary demand. People need hospital care, no matter the macro backdrop. HCA steadily grows, manages costs better than just about anyone, and returns so much capital to shareholders. That's why it trades at the top of peer group multiples. Basically, investors view HCA as the blue chip in a sector that's usually kind of messy and unpredictable. All right, diving into the financials. HCA's top line has nearly doubled over the last decade, from about $37 billion in 2014 to $70.6 billion in 2024. That's a 7% CAGR right there, driven by both adding new facilities and just more patients walking through the door. The headline is steady expansion, even through some wild years.
The pandemic, of course, was an oddball. 2021 saw this huge spike in net income, over $7 billion, mainly from one-time gains and pent-up demand after those lockdowns. But 2022 and 2023, margin pressures from labor and supplies. The positive is, by late 2024 into 2025, HCA showed a sharp rebound, better margins, strong earnings growth again. Numbers-wise, 2024 revenue hit $70.6 billion, net income nearly $5.8 billion. And year-to-date 2025, revenue growth is roughly 9.6%, but EPS is up an eye-popping 42%. So operating leverage is very real right now.
Absolutely. And the outlook's even more bullish for 2025. The company's guiding to $75 to $76.5 billion in revenue. EPS could touch $28. And this is underpinned by, volume growth of 2 to 3% per year, a better payer mix, and continued focus on cost control. Volume and mix both matter. As more patients return, especially commercially insured, you get outsized earnings per incremental admission.
One thing that always comes up on these calls, and frankly was a risk in the tougher years, is contract labor. During COVID, HCA was relying a lot on expensive agency nurses, which killed margins. Since then, though, they've managed to bring contract labor down to about 4% of total labor costs, and they've improved supply chain efficiency. I'd love to hear from an operations lead directly. What's working in reducing those costs? Are these just one-off wins post-pandemic, or real, permanent operational changes?
Yeah, and in the latest report, HCA's management points to longer-term contracts, tech-enabled scheduling, and better retention of full-time staff, all aided by that enterprise IT backbone. I actually think that's underestimated at times. They're applying analytics and tools that community hospitals just can't afford. Cost control isn't just about cut costs. It's about running a tighter ship across a vast network.
Let's break the business apart a bit. HCA groups its operations into 3 big regions: Americas Group, Atlantic Group, National Group. American is their largest, think Texas and Louisiana, pulling in about 35% of revenue, followed closely by the Atlantic, with a big presence in Florida and Georgia. Then the National, which is a bit more spread, but includes a lot of their hospital count. The UK is there, but it's only a few percent of total revenue. This is essentially a US-centric business.
Right, and when you look at profitability, those same regions compete pretty closely on EBITDA margin. American Group actually leads slightly, helped by a favorable payer mix and high efficiency in Texas. Geography offers some risk diversification too. One regulatory change in Florida won't bring down the house nationwide. Revenue is balanced, but no single market is all important.
Now let's talk about the payer mix. About half of HCA's revenue comes from private commercial insurers, so employer plans, managed care, PPOs, and so on. That matters because commercial payers reimburse at higher rates. Medicare and Medicare Advantage are around a third combined, then Medicaid, state and managed, is about 12%. The kicker here? Uninsured revenue is pretty minimal, just under 4%. So HCA isn't stuck chasing bad debt as much as, say, a rural system with more uninsured.
Yep, and the trend's been positive. The share of commercial business is up thanks to both market moves and HCA's urban-suburban focus. They're also seeing outpatient revenue creep upward now at 38% of patient revenue. That's a big change from, maybe 10 or 15 years ago. Outpatient surgery centers, urgent cares, freestanding ERs, those are high-growth, margin-friendly corners of the business, and HCA's been investing hard on that front.
Just to ground this, imagine a patient, say a middle-aged person, goes to a freestanding ER with chest pain. Maybe they get stabilized, have some tests, then sent over to an HCA acute care hospital for interventional cardiology. The patient's journey starts outpatient, but escalates to a higher acuity, higher margin inpatient stay. That ability for HCA to own both steps of the chain increases margins and ensures they're not losing patients or revenue to competitors halfway through.
And don't underestimate scale efficiencies. Lower supply chain costs thanks to Health Trust, standardized best practices, and the volume to fill every bed. That's what drives the 21% plus EBITDA margins, higher than almost any peer. High acuity admissions and commercial mix are real differentiators. Medicaid, for context, pays significantly less, so that mix isn't just accounting trivia, it's the core of the margin story. Okay, let's shift into valuation and the broader investment case. HCA trades at about 18.5 times trailing earnings, 17.5 times forward, and its EV/EBITDA is around 10.5x. That's noticeably higher than peer hospital stocks. Tenet and UHS are both down around 7x EBITDA, even lower on earnings. So why does HCA get that premium?
Part of it is the blue chip perception. Investors see HCA as a safer pick, more stable growth, better capital returns. Plus, their margins and growth outshine peers. Tenet may have a good ambulatory business, and UHS is big in behavioral health, but HCA's scale, geographic spread, and strong commercial mix put it in a different league.
On the DCF side, HCA's mid-single-digit revenue growth, stable 21 to 22% EBITDA margins, and a WACC around 8% spits out an equity value in the $550 range. Not cheap, but justified. And you know, Emily, the company's buybacks are boosting per-share numbers faster than top-line growth, so shareholders are getting a double whammy on returns.
What about scenarios for further multiple expansion, or the risks for compression? Is HCA maxed out, or could it re-rate higher?
It's not maxed out if it keeps delivering. The multiple could expand if HCA beats guidance, surprises on margin, or finds smart growth through outpatient or M&A. Conversely, if labor costs spike again, or a major payer dispute knocks out volume or pricing, the premium could compress towards peer levels. But right now, given defensive sector trends and a bit of scarcity value, HCA's premium seems sticky, unless they stumble operationally or there's a big policy shock.
And for context, most not-for-profit hospital systems have faced losses or razor-thin margins, while HCA's been chugging along at double-digit returns. Another reason the stock's seen almost as a defensive core holding, not just a growth play. Let's wrap with what could move the needle for HCA, on both the upside and the risk side. The big risks are still labor shortages and wage inflation, which can really dent margins, plus regulatory shocks on reimbursement or Medicaid DSH payments. Market risks pop up around payer contract disputes, or if outpatient shift is slower than expected, or if there's a macro-driven drop in elective volumes.
Exactly. Key things to track: quarterly same-facility admissions, contract labor trends, buyback pace, and any M&A hints. And on the upside, expansions into ambulatory, telemedicine, or AI-driven efficiencies, or more value-based care models could provide optionality. If HCA leans more into outpatient delivery, we could well see accelerated growth or hidden margin levers, which might even justify a richer multiple. And don't forget, if rates fall, high cash flow businesses like HCA look even more attractive as bond alternatives for defensive investors.
Let me try to sum it up. HCA offers unmatched scale, margin discipline, and a favorable payer and service mix, with a strong record of converting revenue into real shareholder returns. Defensive, but not boring. There's still upside on execution and strategy. For listeners, all the episode assets, a fact sheet, peer comp slide, and glossary are linked in the description and at research.softgatecapital.com. And a quick disclaimer, this episode is for informational purposes only, and none of this should be considered personal investment advice or an offer or solicitation to buy or sell securities. Always do your own due diligence, folks.
And if you've got questions about HCA or want us to go deeper on outpatient strategy, payer negotiations, or anything else, reach out. Maybe we'll make it the topic of a future episode. Thanks for tuning in, Emily. Always great going deep on these names with you.
Likewise, David. Appreciate your expertise as always. We'll see all of you next time on Global Equity Research. Take care and goodbye.
Goodbye, everyone.